main point is that the very rapid raise in interest rate by central bank will stop probably and slow down. Q1 for the Fed at 5%, Q2 for the ECB at 3%, and then they keep their rate at this level until the end of the year, simply because inflation is stubborn, is high, and you need to be patient before inflation goes back to a more normal level. So stabilization of interest rate. The other implication of this high inflation regime is the correlation between stock and bonds, which is usually negative. That's how you hedge and you diversify a portfolio. And you bet that the performance in the stock market will be covered by the bond market. This has been exactly the opposite this year. Both went down and they both bounced back since the end of September. That's typical of a very high inflation regime. So this is likely to continue. That means that the recipe we've used over the past 2 or 3 decades are gone. We need to find diversification other ways, and that's a big challenge for asset allocation. '23 could be the revenge of the fixed income market. As we say, central bank will stabilize end of Q1, beginning of Q2, and stabilize their rate. So the volatility, the extreme volatility we saw in '22 could decline very significantly next year. That obviously means that the risk profile is much lower. The second point obviously is the rate will stabilize at a higher level. So the period of negative rate is gone, and that's very good news because this means that the risk return profile is much more appealing for an investor. The other point is we do expect obviously the default rate in the credit market to pick up, but to a moderate level, which means that the spread we see right now, because the market is worried, is probably excessive, and we think it will shrink next year. Here again, that will generate some return in this field. So once again, '23 could be a good year for the fixed income market.